All right, everybody, welcome back to lesson number 12. I hope you all enjoyed the previous lesson on charting and understanding price action and putting it in perspective. Today's lesson we're going to discuss a addition or the next logical step to price action and putting it into context. This is called order flow. Order flow is essentially the terminology that has been used by specialists on the floor of the New York Stock Exchange for years and by NASDAQ market makers. Okay, now what I would like to explain to you is order flow are actual orders that create a stock movement. So in other words, it's how to track the big money. When specialists and market makers received orders from institutional clients, essentially what that was big orders that move a stock. And at one point when I actually had them trading on the floor of my trading floor here in New York City, of course I went over and actually asked them, what was it that you looked for? What was it that you watched? What was it that you went through when you worked in order that I could notice this while I'm sitting at my screen? I mean, what person in their right mind wouldn't walk over to them and buy them a slice of pizza and say, let's go talk for lunch? I mean, you handled millions and millions of dollars worth of orders, sometimes even larger than that. What'd you do? What'd you do, and how do I spot that? And think about that edge that you will have when you understand that institutions, generally speaking, which is what all trading is, generally speaking, do not trade both sides of a stock in short periods of time. More often than not, they don't, unless the news story on that particular stock has changed or there's a catalyst, as we teach in the fundamental class, to look for. So essentially what you want to do is you want to find out where the edge is in that institutional order flow. And I'm going to discuss in a couple of minutes why I specifically called it order flow. All right, before we do that, we'll get to the standard disclosures about T3 Live. You can pause that and take a look at it and write it down, do whatever you want. All right. Table of contents. What are we going to discuss here? First and foremost, how does a trader make money? Number two, what is institutional order flow specifically? All right, once we understand what it is, next we get to how do we recognize it, and obviously most important is how do we trade it. Next we take a look at momentum within that order flow, and we'll discuss that in a little bit of detail. How do we recognize that momentum within the order flow, and how do we trade that momentum, whether it's in the direction or against the order flow? And then most importantly, the whole point of why we're here, developing scenarios, order flow and or versus momentum, and then more importantly, setting up the trade expectation of whether or not you believe the momentum is in the direction of the order flow. Now there's a couple of different ways to use momentum in conjunction with order flow. It could be building a position in the direction of obvious order flow, or it could be only trading the next move in the direction of obvious order flow. Now, show of hands, when would you know how to do that? The answer should be obvious. You should know how to do that by developing your trading strategy, which should be in your trading plan by now. All right, first and foremost, how does a trader make money? Very simply, there's a couple of pieces to the equation. First is the right shares at the right time. Now this is very, very important. You always want fewer shares at the beginning of a trade so that if a trade should happen to not work out, there wasn't a big investment in the idea. There wasn't a huge capital contribution in the idea. Now there are certain ideas that have a much higher probability of following through than others. However, while you're learning how to run your trading business, you always want to keep yourself in the game. And quite often in the history of my particular trading experience, where I've managed thousands and thousands of people over the last 10 years, more often than not, trading too many shares all the time, as opposed to understanding when you should have more shares, is one of the most common contributions to people not succeeding. So really the bottom line is the right shares at the right time means understanding when to have more or less. And while you're learning, you want to start out with less so you can prove that your strategy works. All right, next, to determine the right time to have more or less shares, you need to know your trade expectation prior to or before you put the trade on. And this simply means you must understand the probability of follow-through. To word that another way is the probability of your profit target being reached versus your stop loss being reached. Now, if I was you, I would put that on pause and write that down. All right, so in other words, how much of an edge is the market or my stock offering right now? Here's the key. Profitable traders spend the majority of their time looking for an edge, not looking for an entry spot. All new traders do this, and I'll tell you flat out, I did it when I first started trading. When I first started trading, you buy a trading book and you flip right to the chapter on where do I get in? Where do I get in and how do I manage my risk? As I've gone over quite a bit before, pick a side, then pick a spot. Something I would write down as well. Okay, a lot of stuff to write down already. How much of an edge is the market offering right now? Now, I can heartily recommend by the time that we are done with this, you spend some time on your charting software and start to look at some stocks and say, is there an obvious edge I can time an entry into? Most people don't do that. I will tell you again from my experience, most people don't do that. I'm going to tell you the business plan most people have. I have an account and I need to do something. I'll give you a perfect example from yesterday. I was doing my 8:30 game plan meeting with our private mentoring students, and the market was up for about 8 days in a row, or maybe not 8 days in a row, but pretty significantly over the last 2 weeks. And we got to the point where everybody clearly recognized the market's along. However, it was not along at that moment based on how far the market had already moved. The reward potential diminished the further we rallied. And I can't even begin to tell you how many people were disappointed that I told them that if the market sells off today, there's not going to be that much to do because we wouldn't be trading with the institutions. The institutions essentially at that point would just be not as active in their buying. They're basically taking a break. So again, I can't emphasize it enough. If you want to be successful in this business, if you want to take this business to the level of consistency you know that you have inside of you, first determine if there's an edge. All right, next. Finding the edge within that institutional order flow. The whole point of what you want to do is you want to be looking for low-risk trades where there's an easy-to-identify spot to manage risk, as well as a high probability for follow-through, and sufficient reward potential or high reward trades that if you took the risk, there is enough potential to justify taking that risk. Everybody knows that as risk reward. All right, so institutional order flow, what is it? And most importantly, how do we spot it from sitting at our screen and looking at it on a chart? All right, first thing I want to do is I want to clarify a definition. All right, why do we call it order flow instead of the trend? For those of you that a little taken back by they keep using order flow, it's basically the trend. But why do I call it order flow? Here's why. I literally want you to be sitting at your seat, looking at whatever stock you're trading, whatever security you're trading for that matter. But we're going to constantly be talking about stocks here, and ask yourself, can I picture market makers and specialists receiving orders from institutions or order flow that has created an obvious price movement? Remember the last chapter on price action? Markup or markdown. Is there order flow creating an obvious markup or markdown on whatever time frame you're watching? So if you call it the trend, I find that the trend becomes too cliche. The trend is your friend, blah, blah, blah. We all know that, right? Get that out of your head. Okay? Get that out of your head. Literally ask yourself, is there an obvious edge to order flow? Is there an obvious markup? Is there an obvious markdown? Think about it. What is the driving force that moves a stock from 30 to 40? It's not the charts. It's because there's institutional orders. The charts are advertising to us what's going on. Okay, so it's basically buying and selling pressure from institutions. I cannot explain to you enough how many people that I work with, when they first start out, they spend so much time game planning for crappy ideas because there's no obvious order flow. I'm going to tell you this until I'm blue in the face. The easier money is when you only trade with the order flow. Period. All right, so we have two different types of order flow. There's historical order flow, which is buying order flow or selling order flow, which is, you could call it the trend or whatever you want to call it, but it's when you look at it and there's an obvious markup or markdown, as we discussed in the last chapter. And then we have new levels of order flow. So everybody knows there's support and resistance levels or significant reference points, significant price levels that stocks have reached. And when stocks reach new levels, that's new order flow. And I'm going to discuss that in a little more detail in a couple of seconds. All right, so how do you spot order flow from a screen? This is the big thing that the discussions that I had over those slices of pizza with those guys that did work on the floor. We came to I don't want to say conclusion, but we came to a pretty solid determination of how we would recognize from a screen how they were working order flow. Two different ways. Number one is moving averages, and number two is the price action itself. Now a solid habit that I think you should get involved with is don't only look at your charts with moving averages. It's very, very common to get lazy and just say moving averages are moving up, moving averages are moving down. Sometimes you have to, even if you don't take them off your chart, you don't necessarily have to take them off, but sometimes you have to visualize, or if the moving averages are not here, is there an edge to order flow? Is there an obvious markup or markdown? And I'm willing to bet more often than not, if you strip those moving averages out of it, you'll see plenty of stocks that you could take a look back and look and wow, the stock is in a clear range for 2 months. There's no edge. All right, and that's why I want to say both of those on there. All right, these scenarios establish historical order flow on multiple time frames. That's the key there, multiple time frames. Don't get stuck at looking at just one time frame. Go back, go forwards, and literally look to see. Because when I talk to these guys, essentially they would say sometimes there was just nothing to do, and the stock would, we just work orders within a window. And that's what you want to do when you're looking at that chart, or however you decide to look at stocks. Is there an edge, a markup or markdown? This chapter is feeding off of the previous one. All right, so what are you looking for? You're looking for a bias, an edge, as I just said, a trend to the buying or selling pressure. Remember, markup, markdown, accumulation, distribution. Those are the two things that you want to be looking for. All right, so essentially what these are, can you look at a chart and say there's an obvious commitment being made by deep pockets or the big money? All right, so interesting chart we have here. This is roughly the last 2 years. You can see this 2010 and right up here until September, beginning of October of 2011. Very, very clear here when there is something to do. Look at the flash crash of last year, April, and what happened after that. There was essentially, give or take a little bit, almost a 6-month trading range. Once we broke out of the trading range, new levels of order flow came in, end of September, early October 2010, and we essentially had a trend up until late February, early March, where order flow was obvious. So we took out new levels end of October and then proceeded to take out new levels again in December, where we took out 52-week highs there. So there's historical order flow from obvious buying or selling pressure, and then there's new levels of order flow. And then you can see we head into 2011. You can see why it's been a little bit challenging this year. We are in a pretty consistent trading range that we've just broken out of to the bottom now here later in the summer. And you could really get a feel for when more aggressive trading should or should not have been. And I could tell you that during that trading range of February, let's say February through August, it was challenging. A lot of traders were frustrated. But let me tell you something. They were frustrated. Why? They were frustrated because they did not recognize, quote unquote, what was available. Now, let me take a step back. This is what's going on in the market. There easily could have been some really obvious price action in some individual stocks. All right, if you take the Active Trader course, we have a whole chapter on market analysis where market analysis adds to your argument of developing a good idea. And obviously that's how you develop a trade expectation, up or down, for how aggressively you should be holding a position. But this gives you a really good idea in the spiders, the SPY, over weekly periods of taking a step back and saying, is there any historical trend to order flow? And are we taking out our new levels? And that's what you should be doing all the time. All right, so where are we going to make money? Well, we're going to make money when we take out new levels, when there's significant reference points that are breached and new buying or selling orders come into the floor and take out other levels where buyers or sellers took a stand last time and did not let it go through. So new levels we're looking for, there's 5 significant reference points that we look on both a short-term and a long-term basis for new levels of order flow that help us determine new buy orders or new sell orders are coming in and continuing to push past where it could not push past before. All right, the most obvious of the 5 is yesterday's high or low. That represents yesterday's order flow. Think about it. Yesterday's high, yesterday's low represents the highest high that buyers could push it to and the lowest low that sellers could push it to. So literally, yesterday's high and low isn't, whether you're short-term trading or holding a little bit longer and looking to time entries in or out of a trade, yesterday's high and low, it's where the congregation of stop-loss orders are, as well as the extremes that institutions push the stock for the entire day. Next, some other ones are the last completed 15-minute candle, the last hour, and the previous intraday high or low. Now that's for an active trader, somebody trading on a shorter time frame. However, we're going to name these candles, whether it's a 15-minute candle, a daily candle, or a weekly candle like we looked at on the previous chart. We're going to call them foundation candlesticks. And the reason I'm calling them foundation candlesticks is the foundation of current price action, current significant reference points. And if we push out of that reference point, it's more often than not a foundation for a new move. All right, so we're going to look at here is this is a weekly chart of TRV. And what's interesting here on this weekly chart, you can clearly go back and forth. Now I have the 8 and the 21 period moving average on this chart, but that's not what I want to point out here. I want to point out it should be fairly obvious to you now to take a look at this chart and say, could I imagine institutions accumulating a position? What does that look like? Could I imagine looking at when accumulation might be stopping? Can I look at this and see new levels of order flow being made on a week-by-week basis? Can I look at this bottom right-hand corner and see a difficulty of new lows being made, etc., etc., etc.? So do you see what I'm trying to do? I'm trying to get you to look at this and actually picture, can I imagine institutions working in order here? Whether they're accumulating during a markup, as you can see here in those big green candles on the left, or are they distributing stock, as you can see on the right? And now it looks like we're accumulating again. We got that big monster candle there, which is the last previous week. All right, you can actually see the same thing on intraday bias. This is actually a 15-minute chart of the Qs, basically the same time period, over a 2-day window. And even though it's an intraday basis, you can clearly see here order flow moving to the downside on the left-hand chart, where they were clearly intraday distributing stock. But what's the interesting thing there? If you look at volume on the bottom, volume is very light during that distribution. So what did we talk about in the previous chapter? Light volume pauses usually mean a continuation of the previous move, and you ended up seeing that the next day. Look how heavy the volume was while the stock was in intraday order flow, as well as analytical time frames clearly pointing up and creating new levels. And you can see there, interestingly, from a order flow and new level perspective, within the first 15 minutes of the day, you took out the previous day's high. So we actually just said before, those are some levels to watch, and excellent example there in the Qs. Excellent, excellent. And then look at it in the afternoon, actually significant that we had a very hard time creating new levels of order flow from 11 o'clock right up until 2:30, 3 o'clock in the afternoon. So good example there of both. Taking out the previous day, immediately taking out new levels. You could watch for the first few hours of the day there, we're making new levels and consistently bid up by institutions. And then later in the day, it's very, very clear there's nothing going on. All right, so look at those charts a little differently now. All right, so the key to cash flow, the key to combining order flow with the new levels. This is actually a little bit older chart, but it does the job of analyzing in multiple time frames how you combine that order flow. So interestingly, on the intraday charts, order flow is up. Longer time frames, order flow is down. So what you would actually be waiting for is signs that the intraday order flow is starting to weaken back in the direction of the higher time frame order flow, which created that big move, in this case in the spiders, from 84 down to 66. And it's interesting, actually. I guess I would ask you is, do you do what I've done here, where I actually have charts from over 2 years ago to analyze price action? That's how I came up with this one that fit pretty well into the picture here. All right, so what is momentum in context of order flow? Momentum are minor fluctuations within the order flow. Generally speaking, 2 to 6 candlesticks in the same direction. Okay, that's the key there. 2 to 6 candlesticks in the same direction. Now, if it's against order flow, we're going to discuss that in a second. All right, it's much quicker movements than order flow. It's the most recent price action, and if you know how to read the tape, you can literally see that on the tape. It's more of a fluctuation than pressure. It's actually the most recent price action. Now, either one of them is correct to trade. If you want to trade the most recent momentum in the direction of order flow, nothing wrong with that. You know, a lot of traders want to get in, get out, go to the next trade, but only trade it in that direction. Some traders use momentum to begin to build a position, and then during a pause, as we discussed in the previous chapter, that's where they make a determination if they want to add to a position. Now, obviously, because it's a quicker trade than the longer term order flow that's creating it, you have to make shorter term decisions. Shorter term decisions. Okay? All right. Quicker movement, quicker decisions lead to shorter holding periods for that momentum trade. All right, so what exactly is momentum? How do we look at it? Very, very simple. All right, if you've taken the active trader program, we discussed pivot points, and the pivot points are clearly here one of the many ways that we identify as entry patterns. And you can clearly see here on this intraday chart of the spiders, each level of momentum is turned around when a high or low point is made, and basically perfectly stops that move to the upside or the downside. Now, your key to trading this is you want to identify when short-term pauses have ended to initiate a momentum trade in the direction of order flow. That's the key there. Now, we're not going to get all into entry strategies and that kind of thing here. All right, so trade expectation and trade scenarios. Trades with an obvious edge in order flow, as we went a couple of slides back, we looked at multiple higher time frames pointing in the same direction. It was interesting on the chart that we looked at, the higher time frame, the daily, was pointing down clearly. The shorter time frame, the last day or two, was pointing up. So essentially what you're looking for is you're waiting for all of those to line up so that there's an obvious edge in momentum and order flow pointing in the same direction. Sometimes they take longer to develop, but they should be held longer if they're obvious. Okay, if it's obvious, that's going to dictate increasing your share size because the trade has a higher expectation, if you remember what we talked about at the beginning here. All right, trades taken when order flow is less obvious, as we discussed before. In other words, taking if the hourly and the 15-minute are pointing up, but the daily is pointing down, you're trading against that order flow, so you're technically only momentum trading. And you're momentum trading against the order flow, so the time frames are mixed. That should be a quicker, shorter trade with a shorter expectation going into the idea. So essentially what's going to happen is you will know before the trade if you're going to be taking a quicker profit or loss because the edge is smaller. Now, I'm not going to beat that into the ground, but you must write that down. Know the expectation prior to the trade. Is your trade in the direction of order flow? All right, next, how to develop scenarios. Determine if there's an edge to order flow in those multiple time frames. If the answer comes back yes, you have a longer term trade possibility and increased expectation for follow through because you're trading with the order flow. If there's no edge, shorter time frame trade, smaller expectation, and you're not expecting order flow, as we would in that multiple time frame chart that we looked at a couple of slides ago. All right, so before you put on the trade, always ask yourself, am I trading with an order flow of either a markup or a markdown, or am I only trading with momentum, which is the most recent new levels that you see on those charts? This will help you determine the right shares at the right time and how long you should expect to hold the trade. Very important slide here. All right, profitable planning. Always ask yourself, am I trading with order flow or momentum? This is going to determine the right shares at the right time, how long you should expect to hold the trade. Think about what I just said there. It's very important. That's why I'm repeating this. You should know prior to the trade, based on your expectation for order flow, how you're going to manage the trade before you get in. That's a pretty strong statement. Think about that. All right, this is where 95% of most traders fail, in my opinion. They believe every entry signal is the same. No, it's not. Two bull flags, two bear flags at the same time could be completely different trade scenarios based on where it is in multiple time frames and in context of the order flow. All right, remember, so trade scenario, which is order flow versus momentum, will tell you the expectation, and the structure and the thought process that we discussed in this chapter and the previous one will make it easier for you to decide to take small losses and small profits if, quote unquote, that's all there is available. In other words, the expectation is a little bit lower. All right, quick word about breakouts. A breakout or breakdown is technically a momentum trade. You're technically taking a quicker entry, exiting the most recent new level of order flow. Remember, we talked about that before, creating new levels. In the chart of the Qs, we quickly took out the previous day's high. We now know momentum trades require quicker decisions. This means that you may get stopped out once or twice before the trade actually works. So if you go into a breakout trade technically knowing it's a momentum trade, that technically will by definition tell you you might have to make the same trade once or twice before it follows through. So what I want you to do on those breakout type trades is keep the mindset. Every time you take a breakout trade, it's common for a momentum trade to not follow through right away. So don't get frustrated. Just take whatever you've accepted as risk on the trade. If it follows through, great. If it doesn't, just kick it out because it's technically a trade that's breaking out to a new level, but order flow might not be so obvious. If you take a breakout in the direction of obvious order flow, then you got a much better, higher probability trade. All right? End of the lesson. Please pause it, go back, and write down all the important stuff we talked about. Have a great day, guys.